You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Wealth Formula Podcast. And, of course, today is our Wednesday show featuring Zulfe Ali of Valerity Wealth. Zulfe, how you doing?
I'm doing great, Buck. How are you?
Well, I'm all right. It's not too long before this election, huh? Isn't that crazy? Is it me, or is this like the most silent? Even with Trump in this and all that like that, it just feels like there's very little noise about this election right now. Like there isn't, I just feel like it's.
I think it could be just the opposite, that there is so much noise that you can't hear anything.
You think?
I don't think so. I mean, think of all the things that have happened. I mean, just crazy stuff, right?
Well, no, but I'm just thinking the election with, Hillary and Trump. I mean, I just felt like people were talking about it all the time.
Yeah.
Maybe it's because I don't watch the news cycles anymore. Yeah. Maybe that's what it is.
Well, the other piece of it is that I think there's been an increasing use of non-traditional media by both the Trump and Harris campaigns. They're doing a lot of these podcasts and, kind of smaller groups, local groups. They've decided that spending millions and millions on the big, broadcast networks, it's not going to make a difference, because what they need to do on both sides is convince a very small sliver of independent voters. So they got to figure out where are those guys getting their news.
True.
and hit those specific targets. So that could be part of it. But I think, you and I probably don't watch a lot of TV, so we're probably not seeing just a bombardment of ads running constantly. I certainly don't see those.
Well, when mostly my television is either football. By the way, we lost. I'm guessing you watched the game. Is that what happened?
I thought about watching it, but I didn't. So maybe next time I got to not even think about it.
It was a hell of a game, though. I mean,
yeah,
which is crazy because Detroit, right? The Lions are. I mean, they're legitimately probably the best team in the NFL right now. And just listen to what I just said. The Lions are legitimately the best team in the NFL. I mean, talk about times are changing, right?
Right.
I mean, this is a team that has never been good. Never. Anyway, we lost in a last second field goal, literally, I think. Oh. And then we were going to set up for a 75-yard attempt because we've got this rookie kicker who's incredible. Is Reichard, Bill Reichard, and we call him Big Leg Bill. And
75-yard attempt.
Yeah, but then they decided against it, which I think they should have done it, because apparently the guy kicks 70-yarders in practice all the time.
No kidding.
So, but they chickened out at the last second, tried to go for a Hail Mary, and Sam Darnold ends up getting sacked, and the Vikings lose to the Lions with just a few.
So that's one loss on the season, though.
Yeah, 5-1,
right.
5-1.
Right.
I'm going to the game. I'm going to the game on Thursday against the Rams here. So
good stuff.
Anyway. All right. Well, enough football. I guess let's talk. Obviously, we have this podcast about real estate, just very general stuff. But any commentary on that?
Well, I mean, it's consistent with a lot of what you and I have talked about. I mean, investments in real estate as an asset class make a lot of sense in the current environment. We know that, the economic environment supports the growth of this, asset class, with respect to valuations, especially on the residential, real estate properties, right? So you've got the stable economic growth, expectations for a soft or now even a no landing at this point, meaning that, recession's an unlikely scenario. So, you should have a situation where rents are stable and increasing, and you've got, very low vacancies, that sort of thing. Because the workforce is fully employed, and then you've got, on the other hand, Fed is just beginning a rate cutting cycle, and so that's impacting the very short end of the yield curve, which benefits investment properties that are financed by floating debt, shorter term floating debt. So all of that just leads to a really, really good economic backdrop. And then you've got other fundamentals like the supply demand of housing. By the way, the cost and the interest rates on residential mortgages, it has been going up recently. We can talk about that a little bit, but that just means it's even harder for people to buy their own house, right? And so they need to rent. And so landlords are in a very favorable situation, and that helps them again continue to increase rents on their size.
Did you see a guy, the Blackstone guy, what's his name, the CEO, came out, called the bottom?
Is that right?
Bottom. Yeah. He called the bottom for multifamily real estate, and basically said that they were all in.
Okay. Well, yeah. I mean, they made a $10 billion investment back in July to multifamily, and KKR had gone in for $2 billion in August. So institutional money is definitely going into it. That's actually not great for our accredited investor base, because what that means is really you're not going to get a lot of opportunities to go after these assets that could be distressed from a seller perspective, but really, well-performing assets. Guess what's happening? Well, institutional investors are stepping in. Yep. They're going in and recapitalizing portfolios at a time, whether it's 5, 10, 15 properties at a time. They're working directly with the, multifamily operators to do this. And so you don't have this potential, huge supply of opportunities for accredited investors to be able to take advantage of. So,
well, we've been sort of talking about that for a while now, sort of this Goldilocks period. And again, the Goldilocks period being where the interest rates go down, but we know that they're going down, and we can invest into that descending rate market. And at the same time, there are operators that cannot hold on right now. They need to sell. Those kind of distressed situations are going to go extinct for two reasons. One being rates will get low enough so a lot of them will be able to refinance. The other is, as you mentioned, the institutional guys coming in full bore. They're going to clean house on whatever's left in terms of that kind of froth. So I do think, maybe we got a few more months here of really being able to, potentially buy some things with a lot of distress. Then the tricky thing, I think, for us is, I think the switch from where we're at now, which I think is a distressed market that's been beat up with very low liquidity, to a high liquidity market that becomes frothy.
Yeah.
I don't think the distance is that far apart.
Yeah.
I feel like that catch-up game is going to happen. I mean, it could be 48 months, and the next thing you know, we're in a frothy situation.
Yeah.
So.
Yeah, no, agreed. Just because the size of money that is going to be chasing this asset class, I think it's going to go in pretty fast. And so you're going to see valuations go up. Then you're going to have to be a really smart buyer, right? You're going to have to buy in those specific microeconomies that are really outperforming, with operators that really know how to handle their assets. That'll all be key.
And I said 48 months. I really mean is like more like 24 to 36 months probably is what I think. Anyway.
Yeah. But that also bodes well in the sense that you get into assets now, that's your exit window, right? It's going to probably be a shorter term hold at this point, because you're probably going to see valuations go up pretty quick.
No doubt. I mean, I would say that within, just in my group, the accredited investor group, that the stuff that we bought in the last year, right? Starting from some of the stuff in Dallas and so on. Mm-hmm. This stuff's we'll probably unload it in 2 years because I think there's going to be froth, and I think we're going to do really well on those things that we bought. So that's where we're at with that. Anyway, anything else from that?
Well, I think you guys talked about, a variety of different real estate. I'm also watching, the commercial real estate space as well. Everyone had assumed that there was just going to be, again, a bloodbath there. It might take out another regional bank or two and defaults, all that. And that's gone really quiet. That's gone really quiet. The bank sector and the stock market has performed really, really well, including, some of these regional players, which have done exceptional as well. It seems like investors are assuming that, that is not going to happen anymore for the most part. And So I think a lot of those situations got recapitalized, restructured, pushed out, and so interesting that that we're just not seeing any of that fallout on the commercial side, which seemed like doom just waiting to happen.
All right. Well, let's talk about the economy and maybe what's behind all that.
Well, yeah, we talked about it just a few minutes ago. We've had, a string of economic data releases over the month of October, and, one after another, they just keep, reinforcing the fact that the economy's in good shape. We talked about them already. The unemployment, figures came out. They're pretty positive. We've got a 4.1% unemployment rate. GDP growth is, consistently right around 3% throughout the year. And, I think the forecast now is for likely 2.8% growth overall for the year. But who knows? It's probably could be higher. Retail sales are showing, that the consumer is still strong and spending. So we had good numbers coming out there. So all in all, it just, an economy that does not show signs of caving in at all. So it is.
So a lot of people are taking that information and saying, well, does that mean that the Fed's gonna, go back on their projection to cut rates over the course of the next year? What's your take on that?
That is the question. I think, everyone's asking the same. My view is that at least in the near term, the November, December rate cuts where the Fed has said they're, likely to do 25 basis points each of those meetings, I think those hold in place. I don't think there's going to be, a dramatic shift from the Fed's current bias towards cutting, because, that is based on many months of data and what the Fed is expecting the economy to do. And, even the Fed wasn't expecting the economy to completely go into a recession and that sort of thing. I think they felt that it was time to start being as restrictive as the policy currently was. And so they're trying to find where is that neutral rate. Now, could it be that 2025, we don't see all of the cuts that the Fed has projected? Sure, that's a possibility. Or, you get another quarter or two or a month or two and you get some data that points the other way, which is what has been happening, right? September numbers came softer. Everybody was freaked out. Is the Fed, did they cut too late? 50 basis points. Will they cut another 50? All of a sudden, October numbers show, it's actually stronger than we thought in September. Now it's the other way. So I could see this happening back and forth. I think the Fed is not likely to really shift course unless they see some dramatic things going on.
We haven't mentioned it in a while, but we did comment quite a bit on the role of shelter numbers in CPI and how those were lagging indicators.
Yeah.
You would think that those numbers would continue to probably to come down, the CPI numbers. I mean, just, maybe not on a month-to-month basis, but I mean, I think if you drew like a regression line here, you would expect it to continue to go down.
Yeah, and again, I don't think there's been a lot of, in terms of, people being concerned, I don't think there's been a lot of emphasis on inflation, right? So CPI being a measure of inflation, I don't think that there's been a lot of concern that, inflation may come roaring back. I think what the sentiment has been is that if we felt that the current interest rate, the Fed rate, was restrictive, well, we're sure not seeing an economy behaving like it was being restricted, right? It seems like it's chugging along really fine. So therefore, does the Fed actually need to cut? It's got inflation in place. It's, and that seems to be tamed for the time being. And then you've got, an economy that's doing just fine. You've got, employment that's at a good level. Why mess with anything is a question that's coming up. But again, I think the Fed is always looking, many months forward. And I think their concern is that, we are in a restrictive environment still. In fact, one of the, I think Neil Kashkari, one of the Fed presidents, had come out a few weeks ago saying, yes, the economy is strong, but, the policy is still restrictive and needs to be adjusted down. So, they are acknowledging that there's further cuts that need to happen.
I mean, they have data that we don't have, obviously. So, I mean,
Yeah, I think the depth of the data that they get and look into, and that's their full-time job, spending going through the data and stuff like that. So, so for sure, I think their insight is much better than we could hope.
What do the markets think? What do the markets think?
Markets, interestingly, are they're focused on the next couple of rate cuts, and they are relatively viewing, they're viewing that the chances of the 25 basis points cut is almost a certainty. So I think the 80-90% chance a 25 basis point cut happens in November. Similar in December. I think it's closer to 70-75% chance. So I think the markets definitely think that that's the case. If anything, investors are seeing that there's more of a possibility now, not only just a soft landing, but a no landing situation. I mean, the economy doesn't actually get to a point where it has stopped growing. It just keeps growing. It slows down a bit more, but it just keeps growing. Right now, there's a 76%, probability that the market is pricing in of a soft landing, meaning economy comes to a kind of a flattish growth scenario and then comes back. But like you said, you got, folks like, CEO Blackstone, Jamie Dimon even calling the fact that, okay, we have achieved soft landing. It's done. So their view is we are now ready for liftoff again at this point. So,
right.
But it's always challenging to know exactly where you are, right when you're in it. It's much easier when you're looking back to make, a definitive call on it.
So maybe talk a little bit about the effect of that on treasuries, which affect, obviously, 10-year treasury in particular has an impact on mortgages for people, and for mortgages on single family homes.
Yeah. The mortgage rates are definitely linked to the 10-year Treasury yield, and interestingly, that has backed up, meaning that the yield is higher now versus if you look at where it was.
Meaning mortgage rates are higher, right?
Meaning mortgage rates have also gone back up. So the 10-year is up to 4.2% as of today. Interestingly, that was 3.7% a month ago. So right when the Fed had cut 50 basis points, the 10-year Treasury was at 3.7, and similar with the 5-year, which was at 3.5, is up to 4% now. So both of those have moved up 0.5% over the last month. But you might recall, Buck, that you and I talked about the fact that at that time it felt like the bond market or the Treasury market was not necessarily in sync with the stock market. The stock market seemed like, record high after record high after record high was saying, well, the economy is going to do fine. It's not going to head into a recession. Whereas the bond market was starting to price in a much higher likelihood of a recession, and therefore the rates kept going lower and lower. The yields kept going lower. And it looks like it's adjusted itself and is much more in sync with the equity markets now, with the view that, we're probably not headed for a material recession. If anything, we're probably much more likely to head into a soft landing or no landing.
Right.
So my own view is that, things are kind of synced up a little more sensibly now, and both markets, the fixed income and stock markets are kind of viewing the environment very similarly. But like you said, the 10-year going up means that the mortgage rates have gone up to kind of the, mid to high 6%. I'm seeing like 6.75% for 30-year mortgage, which is pretty darn high for single family home buyers and even sellers, because they have to go out and get a new mortgage rate. So, effectively they're buyers too. So I think that is a challenge.
And then what about the stock market? What's going on there?
Stock markets are just loving everything. I mean, the S&P 500 all-time highs are very close to it. NASDAQ has come roaring back because the big tech, the mega cap stocks have all, rallied back to very high levels. NVIDIA, again, breaking records at new highs. All these have come right back. So it's the equity markets are extremely optimistic on the outlook. With, what you do see, though, is a little bit of choppiness in the Russell 2000 index. That is the index that captures, smaller companies. And in an environment where rates, the Treasury yields have gone back up, that implies that those smaller companies get impacted by higher borrowing costs because corporate debt is always priced off of a spread to Treasury, so it's always linked to the Treasury rates at the end of the day. And so for smaller companies, that higher cost of capital is a challenge. And so you see some of those names trading off, and Russell 2000 is down a little bit over the last week. So that, overall though, equity markets are pretty happy at this point. And then you see, I don't know if you've been watching gold, but every week it's showing exceptional performance. This week is no different. Again, trading at record levels, 2,760 per ounce. That is, if you invested in gold at the beginning of the year, you'd be up 34% year to date, which is phenomenal.
That's a big deal for gold.
It's unheard of. I mean, it's phenomenal.
I think I had, I don't actually own any gold anymore, but there was a period of like 2 years where I was holding gold and didn't move at all in those 2 years. And I was like, this is not going to.
Yeah. And the backdrop's still there. Because if you think about what is supporting it, I mean, you've got foreign sovereign, banks, central banks, buying up gold. So that's continuing. You've got, probably a flight to safety in a lot of parts of the world. Remember, gold is a very global asset as well, right? So it doesn't go off of just what's going on in the U.S. markets and the U.S. economy. It's reflecting what's going on globally. And if you've got choppiness going on in places like China and Asia and so on, and Europe, and there's going to be more and more demand for gold as well there. So that's been a really strong story, and seems like the backdrop is there to have that continue. And I also looked up silver because I'm just like, okay, what's going on? Silver's up 46% year to date. That's a 12-year high, so it's not an all-time high, but it's getting up to levels that we haven't seen in a long, long time.
Yeah, I have an old monster box I need to find. You know those monster box? You know what that is?
No.
So it's these silver, the silver dollars is basically a complete silver, and it was, I think, back in 2012 or 13, I was listening to all these people who were, predicting the zombie apocalypse.
Yeah.
And, of course, zombies only take silver coins. So
that's what they feed on. Yeah.
They feed. Right. If it's a zombie run economy, the only thing that works is silver, evidently. So I drank the Kool-Aid and all of it. Yeah. But it's good I did, I guess. I have a monster box somewhere in a garage somewhere. Yeah, I gotta find it somewhere.
Find a way to cash in.
Yeah. Hey, let me ask you this. So, one of the things you just mentioned was part of the gold going up is maybe not necessarily things that are going on in the U.S., but outside. You mentioned the banks, the central banks buying up gold. Is there something inherently going on globally? Is it because of the wars, the instability that would be potentially driving, some of the buying of gold in addition to the general interest from the banks, or what? I mean,
I think investors as well. So outside of the central banks, which have various reasons, right, which we talked about, like, for example, China, may want to continue to decrease exposure to the U.S. dollar, and you have those types of, geopolitical reasons to do that. And yeah, there is some, turbulence, but I think the other piece of it is that, across the globe, there's a lot of economies in the U.S. itself, right, where the fiscal situation, the debt on the balance sheets of the governments is just at record levels, and doesn't seem like it's going to be coming down anytime soon. I heard some chatter as well amongst traders just yesterday morning that there's probably a little bit of a Trump trade priced into this as well. Is that if Trump comes in, he's got these higher tariffs, you see inflation kicking back in, and where do you want to be when inflation is coming back? You want to be in commodities and and real assets and that sort of thing. So I think there's a variety of reasons going on there, but uncertainty, political uncertainty, maybe things all the way up and through the U.S. elections will be enough for people to kind of park a little bit of their investment capital into something that is viewed as a safe haven.
So speaking of Trump trade, you can comment on how Bitcoin it's basically flat, right? But
yeah,
that is a Trump trade right now. I mean, for sure. I don't know if you've seen some of this stuff, but he's talked about buying a whole lot of Bitcoin for the Treasury, and that was also something that RFK Jr. was really advocating for too. That really is a Trump trade, because if Trump wins this election, I wouldn't be surprised if that fuels Bitcoin. I mean, just from the speculation of what's going to happen with Bitcoin.
Yeah, I mean, you'll have speculation, but if the U.S. Treasury decides to buy any small amount of Bitcoin, small for the Treasury, right?
Yeah,
that's a big buyer, and that would put a lot of demand on a relatively small market cap asset class. So. I mean that could be the Trump trade if you really take him at his word at that.
Yeah.
So
okay. You got anything else?
No, that's kind of it for this week.
All right.
Yeah. So we'll just keep an eye on everything.
All right. Sounds good. We'll catch up next week then.
Sounds good. Good talking to you.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.